you and your colleagues at Middlefield are confident now that the North American economy is on path for a soft landing.
Yeah, and what we mean by a soft landing is no major recession, and as well, not outstanding growth either, right? So the word soft in there is really just, 2.5% growth. We actually went through many little recessions over the last kind of 2 years as rates were going up. Technology sector went into recession, the financial sector went into recession when we had the regional bank crisis. So when we look at it now, utility staples, they've all had their period of being in a pseudo recession. The economy at once never had one all at once, right? So yeah, we're hopeful that we've got this Fed put now in front of us where we think Powell doesn't want a recession. So if things start to soften and unemployment's starting to creep up, the reason why markets are at all-time highs, whether it's the stock market or hard assets like housing prices in the US are up again, gold prices, even Bitcoin, right? So you've got assets at all-time high because the market is anticipating if there's any trouble, now we've got room to push rates lower. And I think, Powell speaks actually Easter Friday. I think the market's closed, but the PCE number comes out Friday, right. And Powell speaks in the afternoon. Correct. So I guess we'll all be watching, but not be able to trade it. But, I think he'll reiterate the 3 cuts this year at some point. Maybe we get one in June and one in November and one in December after the election. But the point is the market's anticipating that and should just have a nice landing here of the economy, nice and slow. And then maybe we re-accelerate in 2015 and 2016.
How clear is it to you that market leadership is broadening out from that small number of mega cap tech stocks?
Yeah, when I look at Bank of America, when I look at certain utilities like Vistra, when I look at what would other sectors, when I look at Costco, when I look at Eaton and in the industrials, there's other large cap stocks breaking out, and even the equal weight S&P now is hitting near highs. So I feel good about that. Middlefield, we do have a technology innovation fund, but a lot of our assets are in dividend income. So we own REITs, pipelines, banks, and you can see it in the daily NAVs. When Meta or NVIDIA is down 1 or 2%, our NAVs are actually up because some of the other sectors are doing some heavy lifting for us. So it's good to see, and that's another reason why we feel pretty good about this. The broadening of the market, and even in technology, we own IBM in my core income fund, and IBM's hitting all-time highs, yeah. which was always kind of the redheaded stepchild of technology, but that one's doing well. So within tech, you're seeing some broadening. So it's I think pretty positive, and I think we're in that buy the dip. The market's that chart. The market, that's just IBM, but the market is, over its skis a bit on a lot of technicals, which we won't get into, but the point is we're probably due for a correction. The 50-day moving average on the S&P is about 5,000. So if we get a 4 to 5% correction here, that's healthy, given how much the market's gone up, and I think that's a buying opportunity for investors.
Let's start the questions coming to Rob Lauzon. Ken has written us an email. His subject line is cargo jet. That ticker symbol is CJT in Toronto. May I ask for Rob's outlook on cargo jet?
Thanks for the email, Ken. Definitely still feel pretty positive about cargo jet. We still own some. It's had a nice bounce off the, kind of last Halloween, October 31st, the whole market bottomed, had a nice bounce there, but I think it's still very cheap. If you look at a 3 or 5 year chart, you'll see how much the stock's been punished because it really got tailwinds with COVID, all the overnight shipping, everyone was, all those COVID trends dissipated. But now the business is back to fundamentals, and actually e-commerce in Canada is still growing. We're still very much below trends when we look at where we are versus the US and in Europe for the amount of e-commerce that we use. And, we only have a handful of major populous cities. And Cargojet does all the overnight shipping. So if you want a package from Amazon to Purolator to you order something 1-day shipping, it's going to go on a cargo jet airplane from the Hamilton airport to Vancouver overnight. So they've got a monopoly on that. That's why we like the business. They expanded the amount of planes that they had on order for the expansion, and then they cut back on those. And the market kind of sold the stock off because of lower growth expectations. But that was a free option that they got rid of, which is really right-sizing the company. Expect higher free cash flow, lower debt into the company. We like it here. I would buy it.
Okay, thanks for the question, Ken. Let's go to the phones for the first time in the show. Caller number 1 is Terry from Edmonton. Hi, Terry.
Good day, gentlemen. My question is on Tourmaline. I own Tourmaline, Pado, and Birchcliff, and these shares seem to be holding their own, but I had this brainwave here of selling off my gas stocks and going to oil stocks with the low price of natural gas. What do you think of that move? Thank you very much. Well,
the low price of natural gas is because of what's happened in the last 4 or 5 months, the warm winter. And that's something you can't control. We don't know what next winter is going to bring. It could be the coldest winter on record next year, and these stocks will be on fire. All I know is Tourmaline, out of the 3 you mentioned, Tourmaline has the best balance sheet. They're the lowest cost producer, and they actually get you exposure to oil and liquids pricing. So in theory, what you could do is sell your other 2 gas stocks if you want some oil exposure and get that through Tourmaline. So buy more Tourmaline, do a switch, and then you're also getting their gas exposure too. Because I view Tourmaline as half gas, half oil. And in fact, they get the best gas pricing because when you see $2 gas on the screen, they're often getting $5 gas on the molecules they're sending down to the U.S. Gulf Coast for their LNG contracts. And sometimes they're getting $8 gas for the gas that makes its way to California, different markets. They're big enough to be able to access different markets. So that's what I would do. If you're looking for oil stocks, I would just stick to the big ones like Cenovus. I always like getting some dividends. It looks like they're able to increase their dividend as well. Crescent Point, Whitecap. But I really like Tourmaline here. I was considering it to be one of my top picks. It's not, but that's how much I like it here that you might just want to get more exposure to that stock in particular.
Okay, thanks a lot for that question. Let's go to Jeff now. Jeff's in Haliburton, Ontario. Hi, Jeff.
Good morning. Happy Monday to you.
You too.
Nice to see you again, Rob.
Hi, Jeff.
My question with all the hysteria around AI, I'm looking at Micron and Western Digital for storage reasons. Do you have a preference between any one of those 2? I'd like to hear your answer. Happy Easter, and I'll hang up and listen.
Thanks a lot.
Thanks for the call, Jeff. My portfolio manager that works for me on technology told me on Micron, on storage in general, you have to trade it, don't own it. And he's been buying it over the last 2-3 months. So, and he's chosen Micron as the one. So whether he holds it for a year, 6 months, 2 years, I don't know. But he does look like the short-term outlook for Micron and storage here based on the trends that you got to store this data somewhere. And Micron seems to have put kind of their sloppy 2023 behind them with their last quarter. So, on a day where it's dipping, add to it, but it looks like it's obviously gaining some traction here in the last week. So we do own it. Micron would be our pick, and obviously you know how it trades. It trades like a tech stock, which is either up or down 3 or 4% a day, right? So it's quite volatile.
Okay, thank you, Jeff, for that call. Let's go to Gary. Gary's in Montreal. Hi, Gary.
Hello.
Hey, Gary.
I just wanted to know what's happening in the background with regard to our telecom stocks, and also on top of that, you're thinking that the markets might correct in the coming time soon enough. So I was wondering if it's time to buy or should I wait?
The magic question. Thanks, Gary. So just generally on the market, I expect to get a normal correction here at some point could be one of those spring sell and may go away. It could be a couple months before the U.S. election. Sometimes that's when the peak noise is, which would be sometime in August, early September when we come back from vacation. I don't know how to predict it, but the market is a little overbought, so we're due for a correction. But generally on your telco stocks, what's happened? They've been terrible performers this year. The main reason is the telco stocks continue to spend money on CapEx, 5G rollouts, better infrastructure, and at the same time, their pricing power is being lost. One, you're getting rid of your home phone line. Maybe you're cutting your cord on TV. You're just going to use Netflix and maybe, one of your streaming services for sports. But most importantly, if you go to the mall, next time you're at the mall, look at the prices on your mobile phones. And you go to the Rogers store, the Bell store, the Telus store, the Koodo. They're all fighting right now, and there's a price war, and you can get a pretty good deal. So if you're in the market for a mobile phone plan, you can get a lot of gigs for like $30, and before it was like you were pulling teeth to get something under 50 or 60. That hurts their price. So there's a price war going on, and the market realizes that, which is going to hurt their revenue growth, and so that's reflected here. That being said, I think we're going to get some rate cuts here in Canada soon. These are bond proxies. Like BCE is trading at that's the one we own. It's trading above 8% yield. I think that stock probably rallies 5 to 10% once we start getting rate cuts. So that's the one we own a little bit of, but we're definitely not overweight telecom stocks in particular at our firm right now.
Okay, thanks for that call. Let's get one more call in during this segment of the show. Elliot is in Hamilton. Hi, Elliot.
Please, could I have your assessment of the drug distributor Cardinal Health, and would you prefer it to McKesson and its other competitor? Thank you.
Thanks, Elliot. We do own Cardinal. We bought it, I think it was early 2023, just distribution of drugs, great business, great moat around their business. So we've chosen that one over McKesson. I don't run our healthcare strategies, so I can't really comment on, how much we like it, but we just love that business model. Volumes picked up, especially with these obesity drugs. So there's a bit of a tailwind there as well. But as a diversified portfolio, our healthcare ETF and mutual fund, it's a weighting in it, and we do like it. So, but as you can see from that chart, it's the market's figured out. What we've figured out is this tailwind of volumes here. So, your entry point. I'll leave that to you, but maybe on this pullback at some point we get this year is a good time to enter the stock.
Okay, thanks, Elliot, for your question. Daniel is on the line from Markham, Ontario. Hi, Daniel.
Hi, Paul. Hi, Rob. May I have your thoughts on MEG Energy? Is it still a buying opportunity after a long run-up? And if not, what other energy names you prefer offer more runway? Thanks for taking my call.
Thank you.
Thanks, Daniel. MEG's had a great run. I think investors are looking for good balance sheets with a long reserve life. What happened in the United States over the last couple of years, more so the last kind of 6 months, the M&A that you've seen in the Permian, a lot of that is driven by the search for long life reserves. And the realization is in the US, the reserves are running out. So a lot of that money, I think, came to Canada, where we have our oil sands, 50, 100-year reserve lives. I think also the world's recognized that there's been a heightened awareness that you need energy security, and we're going to be using oil and natural gas for a long time. MEG is not owned by a big integrated company, so it's kind of out there with big tax pools, 50-year reserve life. That's why money's been flowing into that stock in particular. Other names that have long reserve lives like that would be Suncor, Cenovus. So at this level, there's some M&A speculation within MEG, but when you take that out and just looking at fundamentals that you're going to own that specific stock for the next 5 years, Cenovus looks a little cheaper, and we've been kicking the tires and buying a bit of CVE Cenovus, which also gives you a pretty good reserve life on the oil sand side, and they're a little more diversified, but could be another idea for you. But we do like MEG as well.
Thanks, Daniel, for your call. Peter is in Toronto. Hi, Peter.
Hi, good afternoon. My question is just about NVIDIA, if it's a good buy or hold, and if it's going to possibly hit $1,000 soon, and if it's even due for a stock split. Thank you.
Yeah, thanks for the call, Peter. Yeah, I think the stock probably is better off splitting, whether when it gets to 1,000, if it gets to 1,000, that's when they split it 10 for 1. That's what I think some research analysts have hinted at. But generally, we know what's happened here with the company. Everyone's flocking to get their best in breed chip to drive cloud computing for AI. In 2-3 years, will there be copycats where other companies catch up? Probably. So how big is their window and how much is for outsized profits and performance? If they can keep up and meet these revenue targets, it's still trading at 30 times forward earnings, which is not a crazy number for a company that's growing this much. We own lots of it in our innovation funds, and we trim it around the edges every time it gets too much concentration in our portfolio. But we're in this stock for a long haul, so it's just really trimming around the fringes. But I think this is a stock that you can hold for 2 or 3 years and just be careful on your weighting in your own portfolio and bring it back to what's comfortable and use that money to look at other stocks, but always have a bit of a core holding in the name because they are the market leader.
Okay, thanks for that call on NVIDIA. Let's go to Markham, Ontario again. Andrew is on the line this time. Hi, Andrew.
Yes, thanks for taking my call. Yeah, Rob, I appreciate you being positive. A lot of times analysts come on and it sounds like the sky is falling. I know we have to climb a wall of worry, but anyway, thanks for that. But my question is on Novo Nordisk, weight loss drugs. I don't have a position. I don't have a position in Eli Lilly. I'm just wondering, do you own the stock? Is it wise to get into it, and what are the risks? Thank you.
Yeah, we do own the stock in our healthcare portfolios and in our global dividend portfolio. So it does pay a dividend. I don't have the exact numbers, but Lilly trades 50, 60 times forward earnings. Novo's kind of around 35 times. So it's a bit cheaper way to play it. So that's probably, if you're going to pick one of them, a better entry point. Obviously, they've got quality drugs. The risk is that companies can't afford to pay for it. So like your big plans like Ford Motor Company or General Electric, for their insurance plans where their workers want it, charge it into the plan, these weight loss drugs I'm referring to, and the companies say, well, we can't afford it, and then there's intervention to bring down pricing. So that's the biggest risk from a pricing and financial standpoint. The other risk is there side effects? We won't know that. There's always the normal side effects you see on all of these healthcare ads, loss of sleep, nausea, that kind of stuff. But we don't know if there's anything major. We won't know for 5 years. So far, they've all gone through trials. The ones that are being injected seem to be pretty clean. So, but that's your other risk. But I think it is a popular stock right now. All of them are. But Novo would be one that I think you should own some to get exposure to the sector and just look for a few weekdays. And I think it trades as an ADR in the States as well. So that might be an easier way to buy it versus its normal listings over in Europe.
Time for Past Picks with Rob Lauzon. Rob visited with us on September the 1st of 2023, so not nearly a year ago, about 6 months ago or so. He recommended that day as one of his top picks, Chartwell Retirement, recommended at $10.54, now trading at $12.28. That's a return of 16%, a total return, including the distributions, of 20% over about six months' time. Rob?
Yeah, the story's played out as expected. People are starting to feel comfortable to get back into retirement homes. And that was really the playbook. It was coming off a low base of earnings, and the company they're back to getting, close to 90% occupancy. So, they're able to raise prices. It's costing more to care for people, but, I think, the aging demographics isn't stopping. So it's a nice diversified portfolio of retirement homes, pays a dividend. We still like it here. We think it's probably a $14 stock over the next year.
Okay. Medtronic was a top pick on that day as well. Ticker symbol MDT in New York. There you see the numbers, a return of 1% over that period of time. Include the dividends, you get a return of 3% over about 6 months' time.
Yeah, still really like it. Just hasn't panned out. Maybe this is the year where we get the type of returns that we're looking for. They've got medtech products, so whether it's pacemakers, they do some robotic surgery, they do neuroscience products. We just need hospitalizations, people going back to surgeries, and I think we're seeing trends on the positive side there. So I think this year will be a better year. You know, like you said, it was 6 months ago. Let's give it another 6 months. I think you'll have that 10 to 15% total return on this stock and get a lot of it here in 2024. So we still own it and like it.
Okay. And finally, number 3 on that day was Enbridge, ticker symbol ENB. There you see the numbers there as well. A total return, including the dividends, which are a big part of the Enbridge story, of 4% over about 6 months, since September the 1st of last year.
Yeah, Enbridge still is the top holding at our firm. Like, where else can you get a high yield plus, 3% growth in, free cash flow every year? Like, this should be a stock that gives you a total return over time. Year to year is tough, but of about 10%, including the dividend. So, 4% in the first 6 months of holding it from the last time I was on. I suspect you'll get another 4 to 6% over the next 6 months, especially if rates start to come down. Right there is a little bit of a tailwind for a pipeline and a gas utility stock like Enbridge. So we really like Enbridge here. When they start cutting rates, I suspect the stock will be over $50. And again, you're getting that yield that's over 7%, which is very, very healthy.
Okay. Those are Rob Lauzon's top 3 picks from his visit with us on September the 1st, 2023. Later today, of course, he'll give us his top picks for today. There you see it, Chartwell, Medtronic, and Enbridge, a total return over about 6 months' time of 9%. Eugene is in Caledon, Ontario. Eugene, thank you very much for calling.
Good afternoon, Paul. Good afternoon, Rob. Rob, I'd like your thoughts on Emera. Is this a good entry point for a long-term hold, and is the dividend safe?
Thanks, Eugene. Yes and yes. It's been a bit of a struggle with this stock because they've got more debt than the other utilities in Canada. So it's kind of been in the penalty box. Fortis, Hydro One have outperformed it. I'm expecting them to sell off some assets this year, delever, take that worry out of the stock, and I think that gets the stock back above $50. So I think combination with just some management right-sizing of the business plus interest rates coming down a little bit will get the stock up. So yeah, this is, I think, a pretty good entry point, and for sure the dividend's safe. Okay.
Let's go to another caller. Don is in Ottawa. Hi, Don.
Yeah, thanks, Paul. Rob, I'm interested in power. Primarily for a dividend, but I'd like a little growth. I know it's sleepy, but I'd like your comments. Thanks.
Yeah, I kind of view Power Corp as kind of a GDP grower. They own Great-West Life, Investors Group, so they've got exposure to just, the stock market growing and the economy doing well. They're investing in businesses and in a platform that provides private investments to investors and clients. That's brought some volatility into their earnings. That being said, because it is a holding company, it trades at about a 20% discount to what it's holding in all of the underlying businesses is worth. So you're getting good value still here at $38 on Power. We own Power, and we're accumulating it throughout 2023 in the mid-30s or so, hoping that we'll realize where the $45 where we think it'll eventually trade over the next 12 to 18 months. So I like it here. You're getting the dividend. Well-run business. Like you said, it's a bit sleepy, but you're getting good valuations on it. So no problem picking away at it here for sure.
Okay. Thanks, Don, for your question on Power Corporation. Naman is in Edmonton. Hi, Naman.
Yeah, hi, guys. Thank you for taking my call. My question is on Lululemon. My wife is obsessed with this brand, and recently it came down quite a bit because of their earnings, and I was thinking about adding it to my holding. What do you think at this point? Is there a potential upside, or I should wait for maybe another pullback, if you think? Appreciate your opinion. Thank you.
Yeah, this has always been a tough stock from a valuation standpoint, right? Like a fundamental investor like I am that, likes growth at a reasonable price. It's always been tough to get the stock at a reasonable price. So, I think we finally, that it's back to that long-term trend of being in the, with a 300 handle on it, finally below $400. And I think it is a good entry point. At least you can, over the next little bit here, get half your position in for sure. It's a global brand that's well loved, as you just mentioned. It's well known. It's got longevity, and it makes a good product. So, I think you get half now, and then by the end of the year, you're going to either average down or average up. But at least you'll start to have a pretty good investment in a premier Canadian brand.
Okay, thanks for the question on Lululemon. Let's go back to Hamilton. Chris is on the line. Hi, Chris.
Good afternoon, gentlemen. Thanks for taking my call. I'd like Rob's view on Tamarack Valley. It's sort of suffered with the setback in oil and gas, and I was considering adding to my position. I just wondered whether it was a good time to do so or wait for more of a correction. Your thoughts would be appreciated. Thank you.
Yeah, well, it's going to trade with the oil price, and the narrative over the last 8 months was we had too much oil. Now the narrative over the last 2 months has been, oh, maybe we're tight on oil. So you just never know. What I do know is tough to get oil out of the ground below $50, $60 a barrel. Our view is oil's probably $80. Morgan Stanley this morning is calling for $90 oil. That being said, Tamarack's starting to do the right things. They've got the leeway now to pay down debt and buy back some shares. They made some acquisitions to increase their scale in the Clearwater, which is one of the more prolific oil pools in Canada. And to do that, they had to issue a lot of shares. That's behind them. So, we actually added to some Tamarack the last couple of weeks in one of our portfolios. So, to get more oil exposure, get a dividend, and get those qualities of lower debt and higher buybacks. So, we like it. Headwater is our #1 position in the Clearwater, but Tamarack would probably be our second or third, in a diversified portfolio.
Okay. Chris, thank you for your call on Tamarack Valley, a player in Canada's oil and gas sector. Let's go to Brantford, Ontario. Robert's on the line. Hi, Robert.
Good afternoon. I'd like to give a quick comment out to Metafarm Labs Corporation, LABS. I tried to recommend them at 6 to 7 cents. They're now at 9 cents. Tilray has a position in them. I think they're going to buy them out sometime later this year. But, Rob, I'd like to ask about IBM. They've got the quantum computing, and they've got AI, which they've been working on before some of these companies even existed. But why are they not getting any attention? You're the only one I've heard lately that's even recommending it. I'd be interested in your comments. Thank you.
Yeah, I think they got too sleepy. When companies get big, they kind of rest on their laurels, and I think you're seeing that a little bit right now with Apple and Google, some of the mistakes they're making. But IBM was bloated 10 years ago, and they had to spin off Kyndryl, and they lost the edge on quantum computing as well as AI. That being said, we started entering the stock at $140, we were getting tremendous value for the growth in the business, and the revenue line is finally starting to go up. And between their consulting on AI and some of their technologies, I think it's an addition to an AI basket where you're bringing in dividends, lower valuation, which then can complement something like an NVIDIA or one of the cloud software AI tool companies like a CRM or an Adobe or something like that. So I own IBM, but in the same portfolio I do own Broadcom, for example, to kind of give me a ballast of both sides of the AI. But I think they're finally got they've kind of cleansed the company, and it's an easier stock to digest now. And the market over the last 6 months, you've seen money flows into it, and I think it's a good complement to other tech companies that are growing at a higher rate. But you get a nice dividend, which we like at Middlefield. Okay, thanks, Robert, for the question on IBM. Pat is in Mississauga, and Pat's our next caller. Hi, Pat, and thank you for calling.
Hi Hi there, gentlemen. Thank you for taking my call. I'm calling about Broadcom. I know you briefly touched on this company, but I'm just wondering what your thoughts are on it and whether this is a good entry point. Thank you.
Yeah, definitely. It pulled back here over the last few weeks. It was trying to get to 1,500, and now it's 12 and change, or 13. I guess last week I hit 12 and change, so it bounced a bit. But the point is, you're getting an entry point. Yeah, the chart it's doubled here in a year, but it gives you exposure to not just the AI GPU chips. It's got other divisions that will, kind of rhyme and at different times of the cycle, where auto chips are actually doing well, or handset chips, which could come back over the next 12 months, which are kind of in the doldrums right now. So I like the diversification with it, and I like the the dividend grows. It gives you some dividend for a chip stock, and that's hard to find. So I like the fact that you get diversification in dividends and some exposure to AI. Obviously, it's not as much as you would get with NVIDIA or AMD, but it would be our kind of third choice for AI. But from a holistic standpoint, it gives you a pretty good portfolio of chips. So we do own it in our flagship income fund and continue to add to it on inflows.
Okay, thanks for the call. Let's go to John in Etobicoke. Hi, John.
Hi, good afternoon to the both of you. GE has finally made a turnaround, and they've had a good run lately. They will be splitting into the aviation and power generation companies next week. Should I continue to hold, or should I be selling it now? Thank you.
Thanks, John. Yeah, it's a stock that we missed. We own Schneider Electric, we own Emerson, Eaton, and Siemens. They all kind of do the same stuff generally, but General Electric was more of a conglomerate. It's at least cleaned itself up that now I think you can just keep holding it. It's back to where it used to be, as just a, less complex, not over-levered company. So just take the spin-outs as they come, and just I think you just keep holding all of the sum of the parts through all of the spin-outs. So I don't think, even though it's done so well, it probably deserved. It had so much. It was like a coiled spring of underperformance. So just keep sticking with it, and I think you'll be pleasantly surprised how much lasting power it does have. And the other companies, so now it trades more in line with the other companies that I mentioned, Siemens, etc. So it's not super cheap anymore, but now it's just going to do what it should do as a good stock with the economy.
Okay, thanks for the question. Anne is in Scarborough, and she's our next caller. Hi, Anne.
Hi, good afternoon, gentlemen. Rob, your thoughts on Celestica, please. It seems to have been around forever, and now it seems to be like a shooting star. Thank you. Bye-bye.
Yeah, I think we don't own it, but it's had such a good run. It just it's a low margin manufacturing business, so I think you should be happy that you finally got a massive boost in AI. They manufacture a lot of the products for the hardware on AI. So I would for sure, I don't know what your tax situation is on it, but I would look to at least trim half your position and find some other ideas. Obviously, if it's in a taxable account, you're going to have to talk to your accountant. But if it's in a TSFA or an RSP, you had a nice double or triple here, depending on your entry point. I would cycle half of it into another idea here, just because it's manufacturing, a little bit lower margin, a little bit less innovation than other tech stocks.
Okay, thanks, Anne, for your question. Let's go to Renatra in Oakville. Hi, Renatra.
Hi. Good afternoon, gentlemen. I'd like your opinion on TRP or TC Energy. It's a nice dividend payer, and I would appreciate your opinion going forward, and is this a good time to buy it? Thank you so much. Look forward to your answer. Bye.
Thanks, Renatra.
Thanks, Renatra. We own a little bit of TC Energy, but in the energy infrastructure area, I've got one name's a top pick today that you can kind of say is half energy infrastructure. So I would prefer one of my top picks as well. If I'm just focused on pipeline energy infrastructure, I would prefer Enbridge and Pembina over TC Energy at this point. TC is looking to split off their oil pipeline later this year into a different business. They've got a little bit too much debt for my liking, a little bit too high of a payout ratio. Like I said, we do own some in a diversified portfolio. There's room for it, but if you only can buy one energy infrastructure stock, this would probably be my 4th or 5th pick out of the litter. So, you can look at, like I said, Pembina, Enbridge, or even my top pick that you'll hear in a few minutes.
Okay, thanks, Vernatra. Let's go to the email inbox. Nadan has written us. Nadan writes as follows, subject line, Canadian Tire. What's your opinion about Canadian Tire?
Well, I was talking about this at our weekly PM meeting a couple weeks ago. I think it's going to be time to buy at some point here. They just need to clean out their inventory. There was a time when you walked into the Canadian Tire over the last 2 years and you couldn't get a bike, or you couldn't get the kayak, or you couldn't find the product. Now the shelves are stocked full, and people have fatigue on higher ticketed items. People are still going there to get their paper towels or, some auto part supplies, but it's the major purchases I think are being deferred. They need to clean out their inventory. We're seeing that happening in Target. We're seeing that happening in the US stores. So maybe we're on the cusp here. We'll see how the summer starts, and it could be a good entry point. We haven't bought any yet, but it's on my radar that at some point this year we might see a bottom in the stock.
Time now for top picks with Rob Lauzon. Number 1 on this day, Intellia Therapeutics, ticker symbol NTLA on the NASDAQ. Rob?
Yeah, so we have a healthcare platform at Middlefield, broad-based, diversified, ETFs, mutual funds, and the one area that looks really exciting is biotech. It's had 2 years of underperformance, and we're starting now to get acquisitions happening where, biotech companies are being taken out for their innovation, right? They're the higher growth, higher risk innovation that a Merck may buy, and then all of a sudden Merck looks like, where did that drug come from, Merck? Well, they bought it 2 years ago. So Intellia's higher risk, and it's not for all of the listeners, but I just wanted to highlight how much I like biotech, and this is one of our portfolio manager that runs healthcare, one of his top ideas. So it's gene editing. So they use CRISPR technology to target mutated genes and try to cure them, whether they're doing it inside your body or pulling out part of your genome and dealing with autoimmune diseases, rare diseases. So they're doing some third stage trials this year that will be a catalyst for the stock if we get positive news. These stocks can be quite volatile, but we really like the technology and the management team behind this company, and it's got $1 billion in cash, so they're not tight for cash, and that's what can hurt some biotechs when they're doing R&D. They don't have the money. They've got enough cash to last them over 2 years by our estimates for doing R&D. So higher risk, higher reward stock, but I just wanted to highlight that we really like biotech right now, and this is one of our favorite stocks in that area.
Okay. Number 2 on this day, Dream Residential REIT, ticker symbol DRR.UN on the TSX. Right.
Yeah, so Dream Residential is a pretty simple story. They generally have garden-style townhomes, apartments in Cincinnati, Texas, so pretty good demographics in those cities, and a little bit lower rent, so kind of middle-class rents. People are moving to onshoring, is moving a lot of people into Texas, into Cincinnati, so we like that part of it, where they might be able to get some rent increases. They're redeveloping, putting money into these rentals. So the stock's been hit pretty hard recently with, the nervousness on office REITs and real estate has painted a brush on all real estate stocks that have just been out of favor. So I just think it's a real mispriced stock that's trading below its net asset value by over 30%. Its payout ratio is 65, 70%, so it can afford its dividend, which is over 6% yield. So I think it's a real good total return story for investors here.
Okay, and number 3 on this day, we go to the energy sector, which we've talked about a couple of times through the course of the show. Rob's top pick, number 3 today, Topaz Energy, TPZ on the TSX.
Yeah, this is kind of a all-weather energy stock for your listeners. So someone looking for infrastructure, well, half their portfolio is tilted towards getting royalties and owning the dividends off infrastructure. The other half of their portfolio is earning royalties off some of the best companies and best plays in Canada. So whether it's the Deep Basin, Montney, whether it's the Clearwater, they've got Tourmaline as a client, they've got Tamarack Valley, for example, that we talked about as a client of theirs, just earning royalties. So it's a high free cash flow, high dividend model, a little less risky because they don't have a full team of people working for them drilling. They just own the lands that have the royalties associated with them. So it's kind of an all-weather name that you can get growth. I do think it's mispriced. I think it should be trading around $30, but it's so you get growth and dividends and maybe not as much upside as the pure energy producers. But for a lot of listeners that are looking for something that can put in a drawer and forget about it for a couple of years, put it in their RSP, this name does it for me. And even for the one listener that was looking for an alternative to one of her pipeline stocks.
Dividend yield is 6%. The stock has soared since the middle part of February. Is that in line with the rest of the sector on the commodity price rally?
Yeah, the energy stock sector is finally lifting. And I think, you know, people just realize they forgot about the stock in 2023 and you know, money's flowing into the sector and all boats float during that. But I really like this one in the management.
Do you expect crude oil prices to continue to rise, and do they need to rise if the sector is going to do well over the next year or so?
Well, they need to, in my opinion, stay above 75 to have longevity in the investor interest, because investors have such a short attention span right now, where if energy's hot right now in the last couple of weeks because we've had it go from 75 to 85, well, if it goes back to 75, that funds flow, that marginal dollar is going to go back into tech or healthcare or whatever is the hottest new sector. So we do need a little more stability in the energy price, which, you know, we're calling for that $75 to $80 oil to be that price. We're a little bit ahead of it right now, which is fine. But we're okay with it at 75, 80 long term. That gives us lots of opportunity to earn the growing free cash flow out of this sector, and it's just kind of got to be patient with it.
Okay, Rob Lauzon, thank you so much for joining us today.
Good to be back.